Michael Kurtz joins in from the sidelines of the Macquarie conference. Earlier you heard Rakesh Arora with his view on India, but let's get some global perspective to it. Michael, good morning. Thanks very much for joining us and taking the time out from the conference. What's your call on India? It's been a difficult start for our market, and the one tone we've heard from many institutional investors is this year is not going to be great for India.
Yeah, I'm afraid that at least at the beginning of the year we do agree with that. We are actually underweight India in our recommended regional portfolio. And I think what's unfortunate in particular is that the Indian Central Bank, the RBI, has actually been quite a bit more proactive than many other Asian central banks in terms of getting ahead of the curve against inflation. RBI was moving earlier and has moved more than most of the other central banks in Asia, and has been much more tolerant of rupee appreciation as another way of addressing inflation pressure. But the problem is that India, I think, now suffers, from a market perspective, it suffers from a level of political uncertainty related to the issues that erupted late last year with respect to the telecommunications licensing scandal, that has held back a lot of the other important things that the market wants to see in order for this market to move forward, not the least of which, of course, is relatively smooth and efficient execution on the infrastructure build-out. That seems to be largely on hold now as a result of politics. And of course, India is relatively held back by high multiples and fairly aggressive earnings expectations that are already built into the price.
Michael, morning. Some of your peers make the point, though, that India has underperformed quite a bit already relative to Asian markets and certainly relative to developed markets, and therefore maybe this underperformance might just start to peter down a bit. You don't agree with that?
I think there's a case to be made that India's underperformance year to date has gotten more of the bad news out of the way. But unfortunately, when I look at a couple of key metrics, the first being the very aggressive foreign net buying of Indian stocks last year, that doesn't appear yet to have substantially unwound yet in 2011. In other words, of the roughly $30 billion of buying by foreign investors last year, less than $3 billion has actually been sold in 2011, so most of those foreign positions remain in place. And secondly, if we look at the earnings growth consensus for Indian stocks this year, the market is still consensus pricing about 22 or 23% earnings growth in 2011, and that's already fairly aggressive and suggests that there's not as much room for upgrades to the earnings consensus. And if that's the case, then with relatively full ownership by foreign investors and relatively aggressive earnings multiples, even if we do get into a period in which India is able to perform better in either absolute or relative terms, the prospective upside is probably limited by both of those technical factors.
There is a fair degree of variance about what the downside risk to earnings is, though, Michael. What would your own estimate be from what you've seen of earnings trends so far on how much they could slip by?
Well, ultimately, I think this very much depends on factors which themselves have not yet fully revealed themselves. How high will oil prices go in 2011, for example? What will be the trajectory on the rupee if we were to see, for example, any substantial greater capital outflows? And if so, how would the exchange rate affect earnings? Other global key material, commodity, and energy prices that ultimately could impact on Indian profit margins as well. So we're not really trying to come up with a very hard forecast as to what the potential downside risk is for earnings, but rather, if I compare the potential upside risk, in India, I think I'd make the case that most of the good news for earnings in 2011 has found its way into the consensus rather early. Whereas if we look at other markets around Asia, one could make the case that there's simply more potential upside. If we look, for example, at a Taiwan or a Korea where the earnings consensus right now is 11 or 12% to India's 22 or 23%, and I'd rather be focusing on the markets where there's room for potentially as much as an 8, 10, or even 12% upgrade to the outlook, which I think in India is probably very unlikely.
Michael, if your call is that you would remain underweight on India from here, what do you think will lead to this market falling? Will it be the realization that earnings will be much lower than the 20-22% and the market level will fall with the earnings downgrades, or do you think there's further P rating compression that has to be done in India?
I guess I'd make the case, first of all, that the market doesn't necessarily need to fall. We're underweight, but we do believe that the MSCI Asia ex-Japan Index will be up 17 or 18% in 2011. So it's entirely likely that the Indian market will be up on the year, simply not up as far as other markets. But I would at least, I think, want to highlight a couple of potential downside risks over the next half year. The first is very simply that the tightening of monetary policy that we've already seen up until now will continue to have a further impact on real activity. So you may see further curtailment of demand growth in 2011. A second is the impact of rising energy prices and input costs on margin for particular Indian companies. And a third issue that could hold the market back is simply the technical flow environment. If regional benchmark investors conclude that they want to further fund an increase in weightings in Northeast Asian markets like Taiwan and Korea, and they need to move money out of other markets in order to make those positions happen, it's not impossible that investors may continue to dip into their Indian exposure in order to take a larger degree of exposure elsewhere. And then you could see some downside simply as a result of that opportunistic selling in the local market.
Michael, what do you expect to see in terms of flow patterns for this market? I know it's always difficult to map, but we haven't seen as much by way of a concerted outflow yet. I mean, we've been losing money, but it hasn't been a free fall. Do you expect that to happen in the course of the year?
We're relatively optimistic that the emerging equity asset class overall is going to continue to receive net positive flows in 2011. And I think this is very important to emphasize because there has been a lot of commentary from the investment bank community suggesting that there is some zero-sum trade-off between developed equity markets and emerging equity markets. We really don't see that. And in fact, what we expect by way of a zero-sum trade-off between asset classes is really more one in which fixed income globally may be at risk of selling off. But if that does happen, and fixed income presumably would sell off because yields are rising in reflection of higher growth and higher inflation pressures globally, that would produce the liquidity that would ultimately find its way into equities because equities are simply more growth sensitive and more inflation sensitive, and that would mean both emerging and developed equities. So my sense is that the market is far too concerned about this supposed trade-off between developed and emerging equities that somehow is going to be taking liquidity on a more sustained basis out of India and the rest of emerging Asia. In point of fact, we think that as bonds continue to sell off, that's going to produce the next wave of liquidity that will find its way into the region, including in India. And it's a big part of the reason why we think that the Asia ex-Japan Index this year is indeed going to continue to produce the same sort of 15 to 20% gains that we saw in 2010.
You have a good conference, Michael. Thanks very much for your time today. Appreciate you joining in. That's Macquarie, and we'll hear more from the conference. Quick word on